everybody calls me instead of the tax assessor. So I'm getting tons of calls. And I have the tax assessor's number right here. So, okay, so we have a pretty simple meeting this morning. But to start with, I wanted to introduce Stacy. Stacy is a very accomplished financial consultant, and she has agreed to be a part of our committee if we choose to have her, and I'm sure we will. So Stacy, would you like to say a few words for the group?
Sure. Thank you, Chris, and thanks everyone for having me today. I'm really excited to be here and happy to answer any questions that you may have about my background. I'll just give you 2 seconds. I know that Chris included my agenda or my resume, excuse me, in the agenda. So I live just outside of Newburgh, up on Hillside Drive, kind of wine country area. My husband and son and I, well, my husband and I moved here in 2003. I have one son who was born in 2007, so he's a middle schooler now at Chehaman Valley. So we've been members of the community for a long time, but my professional career in investments has really been pretty Portland-centric. I work for a firm called NEPC, which is a large investment consulting firm that's headquartered in Boston. We have over $1 trillion in assets under management, work with a number of different types of clients. I mostly work with private wealth, so families with 200 million or more in assets to invest all over the country. So I've been doing that pretty much my entire investment career. So I'm experienced in working with portfolio management, with fixed income. I've talked to Chris a lot about the goals of these assets, which are much more conservative and capital preservation oriented, which I understand. And then I've been involved in several boards before as well. I was on the CFA Society of Portland board for a number of years and was president in 2007. I'm currently on the board of the Portland Women in Investment Management and play a role as treasurer there. So I'm excited about this because this would allow me to be more connected in a professional way with my local community. And maybe meet some other folks in the community who are interested in finance. So with that, I'll just pause and see if anyone has any questions.
Welcome. Very impressive. Welcome, Stacy. Thanks for being willing to serve.
Oh, thank you, Mary.
Yeah. I was really thrilled. I've known Stacy casually for, well, maybe 5 or 6 years. And because of COVID, we never really got to develop that connection. And I saw her recently and I looked at her and I went, oh my gosh, you're perfect. You're perfect for our committee. So it was happenstance that I ran into her. And so we're very fortunate that she's willing to do this. So I would like to take a vote. I would, someone want to nominate Stacy for the committee? And then we can vote, and then it will go to the commissioners for the final approval when it fits into their agenda. So
I'll nominate Stacy. This is Jim.
Thanks.
And Kevin will second.
Okay, thanks. All in favor?
Aye.
Aye. Opposed? Stacy, don't say no. Well, welcome aboard, Stacy. I'm thank you so much.
No, my pleasure. Thank you so much.
Yeah. So
look forward to it.
Yeah, you'll be a real asset. And in fact, this whole committee is just amazing. And so one of the things that I have decided that rather than, the talent of the people who sit on this committee is cumulatively is way beyond anything that I have as an individual to bring to these meetings. So one of the things that I have decided would be good is if we had a different member of the committee talk about what they see is going on in the economy and kind of give us a take on their perception of what the future may hold. So I have asked Kevin, but before that, we need to handle the approval of the minutes. So do I hear anyone?
I'll move to approve the minutes from the last meeting.
Thank you. Thank you. Okay, so everyone, I think we can dispense with a second. So everyone in favor of that?
Yeah.
Yes.
Anyone? Okay, anyone opposed to the approval, find anything they don't think is correct? Okay, so now I would like to give Kevin an opportunity to share his expertise in the market and the economy with all of us. And thank you, Kevin, for being willing to be the first one to do this.
Yeah, no problem, Chris. Thank you. And welcome, Stacy. I'd like to welcome a fellow logger onto the committee. You know, we're a small school from University of Puget Sound, but we can get wide reaching apparently.
Oh, that's
So
amazing.
welcome to the committee.
Oh, thank you. Thank you. How fun.
Yeah. All right. So yeah, Chris just asked me to give 5 minutes on what we're seeing as a firm. We work with mostly individuals and some nonprofits that range from $500,000 to $2 to $5 million is kind of our sweet spot. And we're pretty conservative, so we definitely are watching the fixed income market pretty closely because a large proportion of our portfolios are in bonds, which I think is appropriate for this committee as well. So the things that we've been looking at, kind of to start with the thing that we're not too worried about, which is the stuff that's happening over in Washington right now with a lot of these arguments. It seems like the markets have kind of ignored like the debt ceiling argument to the big degree. They kind of just shrugged it off either way that it goes. But really what the story has been on our end is the ongoing discussion and question about inflation, and if it is really transitory or if we're seeing more of a long-term trend. I think that it's still too early to really answer that question, mostly because we're still seeing so many supply disruptions. We're seeing, people in America specifically have, the highest rate of savings we've seen in a really long time. We've seen continued support, from Washington into people's pockets. That's increased spending. We're seeing consumer spending go up. It's ebbed and flowed a little bit over the course of the year based on, how open things are and how willing people are to spend. But on consumer goods specifically, the main thing that's holding everything up is the supply chain. People have money and they want to spend it, but it's a question of whether they can get the things that they want to spend their money on. And so once we kind of hopefully work through some of these supply chain issues, which could take a while, it'll be interesting to see if we start to see prices fall back. Once people can get the things that they want, and people can actually sell the things that they want. And then the other thing that, the other thing that's affecting that inflation discussion is the actions from the Federal Reserve, which that has really impacted the stock market as well as the bond market, just because we're seeing the Fed become a little bit more aggressive in the idea of raising interest rates, cutting back on a lot of their bond buying, which has, spooked a little bit of the investors, especially, those high, big growth stocks. And then, we have seen interest rates go up a little bit over the course of the year. But what we've kind of been telling our clients is that long term, we'd like to see interest rates go up, but it's going to be a little messy to get there. So we're kind of expecting some more of this volatility that we saw last quarter going forward. So I don't know, I can answer questions or I can just leave it there.
Thank you, Kevin. So did I understand you correctly? Then are you buying in this bonds in this market? Or are you kind of holding off?
We're kind of continuously buying and selling. Most of our clients are pretty buy and hold. We're income based, really conservative. So we're not necessarily making a ton of tactical decisions at our level, but we're definitely not holding off necessarily. As people put money into the market, we're continually buying stocks and bonds. So.
Okay, all right. And are you buying? What's your sweet spot for terms on bonds at this point?
We've been targeting a duration of around 5. We've been doing that for the last 2 or 3 years. And we invest only with mutual funds in our bond portfolios. Okay. So, but we've been kind of artificially creating portfolios for our clients that are targeting around 5.
Great, thank you. Any other questions? That's, yeah, it's very nice to have someone else do that besides me. So I learned. Thank you. So the next thing I wanted to, two things. I'm going to go to share screen at this point, and hopefully it will. Okay, we'll get there. Thank you. Any other questions? Well, that's an okay. That's is it. Yeah, it's very nice to have someone else do that besides me. So I learned. Thank you. So now we've got the next thing I wanted.
Chris, I think you have your YouTube open.
I do, and I'm trying to find it now. Share screen at this point. I had to have it open in order to start the. Okay. Yeah, we'll get rid of it. We'll get rid of it. Let's just stop that thing. Thank you. Any other questions? You know, there's always something. Well, that's it. Yeah, it's very nice to have someone else do that. That's it. It's so funny. Okay, we're just going to get rid of that. All right, thank you very much. So we don't. I had to go there in order to get that to start, and so I didn't know how to turn it off. So this is today's introduction. I mean agenda, and we've already very happily welcomed Stacy to the committee. We've approved the minutes, and what we haven't done is approve the investment policy changes. So we have the investment policy, which we talked about in the last meeting, has not, the little recommendations that were made were changed. And then this was approved by our in-house attorney, Christian. So this is just a formality for us to approve this so that we can send it to the county commissioners for them to approve it. And, you know, it really isn't, there's nothing that has changed, but it needs to be redone every year. So that's what we have done. So does anybody have any questions about that or comments to make about the investment policy at this time? Okay, so can I have someone suggest that we approve the minutes?
I'll move to
I mean,
approve the investment policy.
the investment policy. Thank you. All in favor?
Aye.
Aye. Anyone opposed? Okay, so this, you commissioners, you will see this soon. The next thing is the LGIP, which I found really interesting, actually. LGIP has raised the effective limitation to 52,713,000 million. Sorry, and this is an explanation which I thought we've always had questions: is how do they come up with that number? Because it's so specific, and so it is connected to the consumer price index, and it goes all the way back to 1995 when they were using a basis of 30 million, and which I imagine is what's been approved by state statute with the escalating based on inflation. So I just thought people would be interested in seeing that. So now we no longer have to wonder where this mysterious number comes from. The other part about LGIP is they did just lower their rates yesterday to 45 basis points from the 55 basis points that we had established last quarter. What that tells me is that it's probably time for me to think about investing more in some bonds, short-term bonds, 3-year, which are currently the 3-year Treasury. This morning I was looking at it, and the 3-year is now 0.64 basis points. So that, and I will probably be looking at more like 4 years. And so we will get not a great return, but we will in fact start to get a better return than we get currently with LGIP. Any input on that? Any suggestions from anybody? All you experts out there? Okay, thank you.
Chris, I think it's,
Yes.
I think it's important to stay invested. And so I think you're doing the right thing to put some money out. As you said, yields have popped up a little bit lately, so
Uh-huh.
take advantage of it and stay invested. That's the only way through this.
Yeah. Thanks for the input, Jim. I appreciate that. So now we're going on to the quarterly report, and we've already talked about rate trends, and I've added inflation to this chart because obviously inflation is what we're dealing with. And so if you can see, inflation is going much higher than anything that we can earn in returns. And so we're kind of up against that, just like anybody else is who's in the market. And it's and now today is it 5.4 they announced, I think. So we're back up from where we were in June. And so it doesn't look like, as Kevin said, I'm a little skeptical as to whether or not this is going to last. I think it's an aberration, just as Kevin explained, but it needs to be watched, obviously. And we certainly can't invest and get a higher return. So we're effectively losing some of our buying power for the interest that we receive. The trend which we have in here hasn't changed. I still think that we'll, between LGIP and our investments, earn around 650,000 in this calendar year off of our investments. It could be lower, but right now I think it's still accurate. So the portfolio, as of now, we have 29 million in LGIP. And then we also have the 10 million in the ARPA funds in LGIP. So one of the things that Mike Barnhart and I have talked about is trying to keep it no higher than 45 million. Well, we're nowhere near close to 45 million, but that's because of the time of the year in terms of collection of taxes. And so I am going to start, as I said, buying some more probably agency and treasury bonds in this market. And so it's going to go down even lower, but it'll pop way back up in November. So I'm just trying to get prepared for the fact that we need to earn a little bit more money longer term. I have been, and I still am concentrating, as I said, on the agency and treasury bonds. I think that those returns are, in terms of risk reward, are perfect for our portfolio at this point. I'm not opposed to buying good quality corporate bonds, and I have seen some that have some nice returns that are short term. So I may be doing some of that as well. We earned 43,000 in LGIP dividends, 111,000 in bond interest last quarter, and the ARPA funds, which of course are very important. They earned 14,000 in the last quarter, and so now it's up to 10,422,000. And I know that the commissioners are in the midst of allocating that money. So we'll be getting another 10 million. Mark Barnhart probably knows when, but I think February or March, that will be the second half of the money that has been given, if you will, to Yamhill County to spend.
Chris, the second tranche of ARPA funds is expected in May.
In May, okay.
In May.
Okay, good. So, and then you have, I believe that the commissioners are double planning at this point where they know that's coming in. And so that may not stick around quite as long as this. One of the things that I get asked frequently is, why is that money not being spent? And I try my best to explain to people the process that's involved in making those decisions and making certain that it goes to the right people, because this isn't something we're going to get every year. So if we don't use it wisely, and I know that the commissioners and Ken have been working diligently and making certain that those funds are used to the best benefit for the county overall. And I appreciate that. And that's what I tell people, just in case you want to know. So the bond investments are only at 20 million plus at this point. And we still have an unrealized gain in that portfolio because we have some of those higher yielding corporate bonds. And so we get the benefit of that. And so we have a 1.63% yield on market compared to, if you look down below, the benchmarks, which are considerably lower than that. The weighted maturity now with the elimination of some of the longer bonds is 2.45, which I feel is appropriate for this portfolio. And our rating is AA. And the AA is, we have as I said before, we have a lot of agency and US Treasuries now, which are bringing that up. We still do have $740,000 in bonds that are BBB plus. And one of the things I wanted to ask the committee is whether or not the committee thinks that we should be selling those bonds. So when we look at these bonds, we have top bond holdings is, as I said, it's the agency, it's the Treasury, state of Oregon, Exxon and Westpac. That's not a lot in there. That could be just it's just a couple of bonds. So the top bond holdings are conservative and highly rated bonds, but the top 5 organizations account for 63% of the portfolio. And in terms of maturity, as I said before, I think we're doing really well. We're nowhere. We only have 18% in longer term. The majority of our funds right now are in 30 days or less because that's LGIP. And then the rest, and it has been my hope to make it spread out over those other time periods. And it is showing some moderation. We don't have any big chunk that is going to mature in 1 year. So I'm happy with that. Now, this is what I'm not. Oh no, this is okay too. This is our callable bonds. Now, essentially, all agency bonds are callable. And so since we have a lot of those, we have a high number of callable bonds at this point. I'm okay with that. I figure if interest rates go down, which is when they would be called, if they go down, they'd be called. And I'm not really thinking that rates are going to be going down a lot over the next year. So in general, our maturities are, as you can see, are bunched up. It's really more of the same. This is what we had last quarter. I didn't buy or sell anything. And what we did have, though, is we had maturities and we had bonds that were called. And I was kind of surprised that Wells Fargo called their bonds when their bonds were the ones that we wanted to sell. So I was kind of happy with that. But they were earning good rates of return. The only one that the Federal Home Loan Mortgage at 1.125, that one matured. The Fannie Mae, that matured. So for the most part, they're taking away our high rate of return, but I would expect that. Any questions about that? It's really not much.
Chris, I have a question. This is Mary.
Yeah.
I have a question, but it was several
Okay.
slides ago.
Oh yeah, I should.
And that had to do with the ARPA, the interest on the ARPA funds. So those, and maybe Ken, I think we might have even touched on this at one point, strings attached to that.
That would be Ken or Mike question.
Yeah, I think I still need to dig into the treasury guidance. I know that was an outstanding question. I haven't had a chance to follow up on that, on whether or not there's limitations on how we can use the interest earnings on our ARPA funds. So I'll have to get into the treasury guidance and see if there's similar restrictions that, you know, or whether or not that's discretion, any earnings on that are discretionary in nature and not tied to the treasury guidelines. So I will get an answer on that, and I can also report back at the next meeting here, but I can follow up with the board as well with the answer.
Okay, thank you. And Chris, what was that number again? Did you say
Yeah,
14?
let me go back up to
$14,834.
$834.50.
Okay. All right, thank you.
Yes.
That
you're
would be,
welcome.
that would be a whole nother grant for somebody.
It would. So see, there's benefit to not running out and spending that money. You get more money. Yeah.
That's right. Thanks a lot. Thank you.
Yeah, you're welcome. I look forward to seeing that get put to work as we all do. So the credit watch list. So we have Oracle and we have Wells Fargo. And we have every quarter, nothing's changed with these bonds. But the question that I would throw out to the committee is, do you think that we should consider selling these bonds?
Chris, when are do you have maturity on here for these? When are they just going to naturally roll off?
Oh, yeah, I'm sorry, it's not on there. Okay. Let me go down here. I can look at the oracles. Oh, let's see, the holdings aren't by maturity. Let me look. It's a very good question. So one of them is 5/15/25.
Okay, so a ways out.
Yeah, I think that, yeah, they're fairly long. I'm looking at,
Yeah.
here's another one, 11/15/24. This one, 10/15/22, that we could probably hold on to. And then Exxon. Is that the other one? Now I've forgotten which one's there.
Exxon's right.
Yeah, so that's in 22.
Okay.
So the you know, as I said, we've held on to them. Wells Fargo. You know, my tendency, and I've always said this, is to think that these companies, these two companies are fine. And I'm not real anxious to sell bonds. We've done some of that, but you know, as long as, and I watch what's going on, and you know, Wells Fargo's had ongoing problems and challenges, but I don't think they're going to go under. But they are low, and it's really a matter of our discretion, my discretion, but with your input is helpful as to whether or not we continue to hold them.
Do you know if you were to sell these bonds, if you'd sell them at a loss, or if they would?
No, I would not. I would not sell them at a loss. I'm sorry, I don't have all that on there.
It
That's,
looked like, and I was looking at it quickly, but it looked like they might be trading above par right now.
they are.
So you would realize a gain.
Yes, like the one for, yeah, there's 4298 for one Oracle, another Oracle's 3418.
And I feel like if they're out of policy and we would get a gain, then there isn't a lot of downside to selling
Yeah.
them.
Yeah, the third Oracle's 15,000 actually. And the Wells Fargo, let's see where we are with Wells Fargo. I hope I'm not making you guys dizzy. Flipping around here. The other Wells Fargo. It coming up pretty soon. Well, I don't see it. It's here. Oh, there it is. Wells Fargo. Yeah, we have a gain on that. We have a gain on all of them. But so we could sell them, and we could reinvest them at a much lower interest rate, but we would have the gain as well. And I'm not opposed to doing that. But I feel like when we sell out bonds for credit reasons, that it's good to have the input from the committee. So what I'm hearing is you guys think it's probably a good idea?
This is Jim. I think
Yeah.
that Stacy's question about maturity is really important. It's like, how long are we in this? If it's a short time, excuse me, generally, I just told them, don't generally sell because of a downgrade unless it's really long dated. You can't see that far out, envision that. I don't think Oracle or Wells is going to default. But if it is outside policy, then, and you can sell at a gain, I think that's fine. If it's a short dated maturity, I wouldn't take a loss. If it's a longer one, then that's a tougher question. But
Yeah, go ahead. Who is?
For those that are longer, even if they don't default, which I agree, if we do, they're trading at a premium right now because they have a higher, yield relative to other options, and spreads have narrowed in corporate bonds and high yield corporate bonds relative to treasuries. So I think it is an attractive time to sell, especially for those that are dated in 2025, because certainly you could see rates go up between now and then, and that you could have some spread widening for those corporate bonds, meaning that they would that gain that you're seeing right now could definitely disappear. It
could. Yeah, I'm surprised actually that the gain is as high as it is on one of these oracles. It's like 15,000. Yeah, it's the one that's in 24. There's a 15,000 unrealized gain. That's substantial. We bought it at a discount as well. So that's okay. Well, I think what I'll do is I'll look at the maturity dates more closely. And if it's going to mature in 22, I'll probably hold them, but anything beyond that, I probably will sell because we can hold till 22, I think. So thank you for the input. I really appreciate it. The next thing here, this is the thing so when we had the last quarterly meeting, I mentioned that I had purchased a Royal Bank of Canada that was A2 rated, which is below the state statute. And I said at the time that I did that because, and it's not really a good excuse, was because Mike told me that we could buy A corporate bonds. And I was new and I thought, oh, okay, that's great. And I just assumed looking at the portfolio that was in fact the case. Well, the auditors came, and fortunately I was on top of this, and they came and they found, in just pulling randomly, they found 3 other bonds that were purchased, that Mike purchased in the last year that also did not meet the minimum quality standards. And so they found 4. They found the one I did, and then the 3 that Mike did. Well, then I started looking, because I was pretty certain that I wasn't imagining that he said I could buy A. Well, it turns out he consistently bought bonds that were not of the high enough quality to meet state statutes. And as far as I looked for it just the last year or so, and everything that he bought, because they only picked 4, everything that he bought that was corporate was below approved standards. And I kind of flipped around and looked, and it looks like that's been a pattern the entire time. Now, he has obviously purchased some that are higher rated, and that's good. But he did, so this is the list of the bonds that we currently have in our portfolio that are at this time, if we were to buy them, they would not meet our credit standards. That does not mean that all of these bonds were below credit standards at the time that he purchased them. And I have not gone through because there's no reason to go through and beat a dead horse, not to call Mike Green a horse, but it just, it's a disturbing trend. Now, all of these are in fact good bonds. And I don't see that we have any reason. And I talked to the auditor about that. I said, well, what do you recommend? And she said, well, that's totally up to me and my discretion as to whether or not we sell. And she's not going to get involved in that decision. So I believe we should hold all these. But I also felt that it was appropriate to let people know that this has occurred. And that it will not occur again under my watch. But it did. And these kind of errors, this is why the investment policy is so important. And the investment policy, if it is followed, this would not have happened. Is there any comments or questions about that?
Chris, I have a question. Excuse me.
I expected you to, Mary.
Oh, well, just as far as oversight on that, because those are significant, I know that I certainly wouldn't be able to tell whether or not they were up to par, so to speak, for our portfolio. So as far as the oversight for that in the past, what was it?
Well, it's a good question. One of the things that I think, how to say this, the reporting that was given to the advisory committee is in place. Now, it should be said that not all counties have advisory committees. They're not required. So we did have an advisory committee, and the advisory committee, in my mind, is there to make certain that the treasurer is following the basic procedures and making good decisions. And when we had, and I was on the advisory committee as were Jim and Katie, and the reporting that we got was not detailed enough for us to see the purchases in terms of, what was the rating, plus there's, it was very hard to actually know what was going on with the portfolio because of the way that the reports, they were kind of confusing. And when asked questions, I sometimes felt like I was stepping on toes. Anyway, so that's the thing. And that's why I have gone to great lengths to produce these transparent reports that have, if we'd had purchases like we have in the past, it would have every detail about that purchase and even who I bought it from, which is also important because we need to know, who we're getting our investments from. Does that answer your question?
Yes, it does. Thank you.
Yeah. And I don't mean to make the people on the committee feel that they have a huge responsibility, but in fact, they do in terms of keeping me in line and whoever comes after me in line. And it should be an issue, but it's just really important. And even, I made the mistake and I didn't even know I was making a mistake. And so I learned from that, but and that was on the quarterly report and, it looked fine. So it's important to know what is in the investment policy because what looks normal for those of us who have been in retail or any other kind of investing is an A bond is not a bad bond. An A bond is a fine bond. You get a better yield when you buy an A bond. And that's why Mike was buying those. Because this is so overly strict, it is sometimes hard to recognize when something doesn't conform.
Chris, if I could comment,
Yeah,
I think you're right. The reports that we received from Mike were lacking in some certain details, and we did not have a schedule of purchases with the credit rating. So we never saw those credit ratings at purchase. And then we saw the total portfolio with the credit ratings. And the challenge is that a single A credit is fine to hold in the portfolio. It's not a violation of policy. It's just the purchase that was a violation of policy. So that's where it gets confusing. So, but I believe that these bonds, while they might have been lower than credit rating at purchase, they're still within policy as they stand today. And I wouldn't make any changes. I told them it's done.
Yeah.
In my opinion.
yeah, no, I agree completely. I wouldn't consider selling something until it gets like those others have down in the B category. Yeah, these are fine bonds. I'm sure that, and they're good names. You know, they're traded. They've got they have markets for them. They're not obscure. They're just good. The volume's good. Any other comments? Okay. So let's look. Oh, and so the rest of the report is simply our holdings and then the transactions. Transactions being primarily interest and a few items that were called are matured. And so that is all I have to say today. But I would love to have, one of the things I always stumble with when we do these quarters is that numbers are not very interesting to talk about. So to me, it's because I work with numbers all the time. It's so much easier just to look than it is to try and tell people what's in the numbers that are in front of them. But, it's important that you see them. And I encourage you to read the reports. And if you have questions about the reports when I send them out or anything else, you're always welcome.
I have kind of a general, maybe kind of process question, but for the LGIP funds, what is the process? Like, what's the liquidity for us on those? Like, how easy are they to access?
Overnight.
So my question is, if we're going to be going, because like it looks like it's been trending sort of with the 3-year treasury-ish in terms of rate. If you're going to go out and buy a 3-year treasury, why wouldn't we just max out the LGIP funds first? Because if interest rates are going to go up, I'd rather have the flexibility of, if we buy a 3-year bond now, in 3 years, we don't know what the interest rates could be. I would think we would want to maximize the liquid bond. If we're getting a decent return and it's liquid, I'd rather have more money there than locking into a 3-year bond with the interest potentially going up. So I just question if you've thought about that or not.
Yeah, Kevin, it's a good question. I think about it all the time. And one of the things is that if I go close to 5-year, I can go 5-year according to our plan. But if I go somewhere between 3 and 5-year today, the treasury is 0.64, and then for the 3-year, 1.08 for the 5-year. So I could probably get 80 basis points, and the LGIP is 45 basis points. So that is a difference. And but I don't and because I want to keep a portfolio of bonds maturing over a certain period of time, I don't want to just run out of bonds one day because everything matures. But it is a day-by-day decision. I saw a AA corporate bond that, AA corporate bond that was paying 80 basis points that was 4 years. And to me, that's worth taking out of LGIP.
Yeah, I guess my point was just that if we are in a, which I think we are in a rising interest rate environment, that there might be a benefit to add liquidity versus pure yield. That liquidity has value over yield.
Yeah,
In that type of environment.
Yeah, and that's what I've been doing, and that's why I was asking that question today. Is but I think that if we had sold the 740,000, I might have been likely to put that back into some bonds. You're absolutely right. And as I said, I look at it every day, which is why there have been no trades in the entire first quarter, because I just haven't seen that makes sense. So thank you.
So I'd like to comment. I understand Kevin's comment. I also like to mention that I think we're about to come into a lot of liquidity, right, with taxes.
Right.
So you're going to be flush again with liquidity, and you're building a series of cash flows, right? You're building a ladder.
Right.
So
I'm
you've
building
got
a ladder,
series
right.
of cash flows that are constantly being reinvested, and
Yeah,
so
I am.
cash flows came. So either way, stay liquid or maintain your ladder, and you'll be fine.
Yeah, I am building a ladder, and that's why I would like to have a ladder over a 4-year period. And I have to add on the back, I've got to feed the ladder. And but you're right, Jim, we're going to get a lot of money. I know, Kevin, last year, our problem was that I had to invest money really fast because we were so way over what we were allowed for LGIP. I mean, it was shocking to everybody. I mean, the question is, where does this all come from? And so I did invest it all. And I would rather take the opportunities knowing that that's going to happen in November. If I see something now, I'll buy it. But also, you'll see there'll be amount, because we were over 100 million in LGIP.
Oh, wow.
Yeah.
Okay. Well, I think it makes sense then to put it off until we get that tax money in, and then maybe revisit the
Which
discussion.
isn't very long. That's why
Right.
I'm getting
No.
all these calls for the tax assessor as we're talking.
Yeah.
But thank you. That's exactly what I want. I want you to ask those questions. It's good. I appreciate it. Ken.
So I just wanted to really quick, kind of switching gears. There was the question about the ARPA funds and the restrictions around the interest earned on those. The interest that we earn is not subject to the program restrictions. So it's really up to the board on how we want to use that. So any interest earned, because we're not even technically required in looking at the Treasury guidance. There's state statute that requires that we keep funds in interest-bearing accounts, but there's not a requirement for these funds from the Treasury to do that. I will say that, some of the recommendations that have been floated out there is using those funds to offset the administrative costs associated with managing the funds, and we do have that budgeted built into the budget, and how we have these funds booked into the annual budget. We are charging some administrative internal charges against these funds because of course our finance office and county counsel's office and some of those internal controls all play a part and help it to manage these funds. So again, the interest earned on it's not subject to the program requirements. It's just the core 21 million that has to be spent, per Treasury guidelines.
Thank you, Ken. Yeah, that's good for everybody to know. I know there's been discussion. It doesn't affect me, but I'll just keep earning the money, even at a low rate. I'll just keep doing it. Yeah. So anything else for the good of the cause? I thank you for your time. The next meeting is scheduled for January 12th. Well, it seems so far away, but it won't be. And it will be a Zoom meeting as well. And please, as you think of things, or you have questions, email me and let me know, because one of the drawbacks to being a single treasurer investor for a county is that I don't have any peers. And so you guys are my peers. So if you have conversations about things that are of interest to you, they're probably of interest to me as well. I read a couple hours every day, and all the currents goings on, but it's nice to have people who can also say, hey, look at this. So thank you all for being part of the committee, and I hope to hear from you. And if I don't, have a happy holidays. And I'll see you in January. Thank you.
And welcome, Stacy.
Yes.
Thank you, Casey.
Yeah.
Thank you, everyone,
Yeah.
very much.
All right. Bye.
Bye-bye.